This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 30 of Value Investing. In the last episode, we discussed 9 rules from Peter Lynch's book, Beating the Street. And we're going to continue to talk about the rest of the rules in this episode and the next episode. And as I mentioned in the last episode, Peter Lynch is a legendary value investor who was mutual fund manager. And as the manager of the Magellan Fund, Peter Lynch was able to average 29.2% annual return, consistently more than doubling the S&P 500 market index between 1977 and 1990. So his performance was excellent, and we are trying to understand what his investment philosophies are by looking at his investing rules. I'm so excited to cover his investing rules, but before we get started, let me give you a quick disclaimer that this podcast is for entertainment purpose only, and it is your responsibility to consult with your investment professional for any investment decisions. Without further ado, why don't we get started? Okay, so let's talk about the first rule for today's show. Never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. Always look at the balance sheet to see if a company is solvent before you risk your money on it. So this is good advice. And I think that as a value investor, you'd probably look at all different financial statements, including balance sheet, income statement, and cash flow statement. But particularly Peter Lynch is putting the emphasis on balance sheet here because that actually provides the probability of this company going bankrupt in the near future. So what kind of things do you have to look at from balance sheet perspective? You have to look at whether or not the company has enough cash to meet all of its debt obligations over the next few years. You can take a look at quick ratio or current ratio to see if the company has enough liquidity to meet the obligation of the debts that it holds. And second, you also have to look at how the company can handle the current debt level and whether or not it is sustainable over the long term. You can take a look at debt to equity and debt to asset ratio to understand how much the company's debt level is currently relative to other type of assets. More importantly, you have to look at how much interest-bearing debt the company has because that's the part where the company can get into trouble. In some cases, if you look at insurance businesses, the liability numbers on the liability side of the balance sheet actually are good if the company is operating under underwriting profit. So the debt is not necessarily a bad thing, but the cost of debt is high in some cases if you look at the companies issuing junk bonds. So you have to be very careful in terms of assessing the debt level and whether or not it is sustainable over the long term. Look at what happened to Valeant Pharmaceutical Company, which acquired a lot of companies over the course of last 10 years, fueled by issuing debt. So because of huge debt amount that the company holds, the company's stock price has been depressed for quite a while. Look at what happened to GE, General Electric. Because of the debt and also pension liability, the company has been struggling to boost up its stock price, and that's right now the top priority that the management has to solve in order to gain confidence from investors. So it's important to emphasize how you look at and analyze balance sheet on top of income statement and cash flow analysis. On this point, I just want to point out one more thing. You can also leverage the analysis already done by credit rating agencies such as S&P, Moody's, and Fitch. They publish bond ratings for many different companies, so you can get this information for free. So why don't you just leverage rating published by these different rating agencies? And if you look at how bond investors invest their money, they mostly look at the balance sheet and they want to make sure that whatever bonds that they buy, they get their principal back in the future. And the most important thing they look at is the soundness of the balance sheet. Okay, so let's move on to the next rule. So next rule says avoid hot stocks in hot industries. Great companies in cold, no growth industries are consistent big winners. So this is quite in line with what other value investors have as their principles. So if you want to be a big winner in this space as a value investor, you have to look for the things that other people have ignored in the past. So which means that it's likely that the prices of these ignored stocks have been depressed for whatever reason. But if you look at hot industries, hot stocks, then it's likely that there's enthusiasm already built into the stock price, and you're not going to be able to find bargains there. So if you look at traditional industries, very boring stocks, in some cases you can find great bargains, and which will lead to probably stock appreciation over the long term. One stock that I want to give as an example is Amazon. I love Amazon, I love Jeff Bezos, and I think that Amazon has a good business model, good management team. But the thing that I don't like about Amazon is that the price is too high relative to its earnings. So as a value investor, I have avoided Amazon stock, and what's quite interesting about this Amazon stock is that there's a lot of enthusiasm built into this price. However, because of managerial expertise and brilliance, the Amazon stock has been overvalued for many decades. But I'm okay as a value investor to miss out this opportunity to invest my money into this great company because the stock price is just too high relative to its earnings. And I can find other great investment opportunities aside from Amazon in other places, and I can still make money. So that's beauty about investing money in the stock market. There are many different ways you can make money, but as long as I stick with my principles as a value investor, I can make within my own space. I don't have to worry about making money off of Amazon or other companies like Tesla because their valuations are just so high for me to put my money in. So the next rule that I want to discuss here is with small companies, you're better off to wait until they turn a profit before you invest. This is also very interesting advice, and let me just try to put some distinction between value investors and venture capitalists because the business model is completely different. So as a value investor, whenever I try to pick a stock for my investment ideas, the first thing that I look at is whether or not this company can make money right now and also will lead to some capital appreciation in their long term. I look at the current business model and only invest my money when the business model is sound enough and also business is already profitable. And that's what Peter Lynch is saying that. So you don't have to invest your money when the company is small and does not make any profit. But that's not the business model that venture capitalists have because what they're trying to do is completely different from what we are trying to do as a value investors. Because venture capitalists can pick many different investment opportunities and they can actually fail on a lot of these investment opportunities as long as they can make a few investments turn into success. So these few investments can bring tons of money to the venture capitalist, a lot of returns to the venture capital fund. They can make up for the losses they experience for the rest of their investments. So it's just a different business model, but I think that both models could work as long as you're careful and as long as you know exactly what you're doing. So Peter Lynch is here suggesting that we have to be value investors, and for these small companies, you're better off to wait until they turn a profit before you make an investment. I agree with Peter Lynch, but venture capitalists may disagree with what Peter Lynch is saying here. So let's move on to the next rule, which says if you are thinking about investing in a troubled industry, buy the companies with staying power. Also wait for the industry to show signs of revival. Buggy whips and radio tubes were troubled industries that never came back. Let's try to understand what he's trying to say here. So you can invest your money in a troubled industry, but you have to buy the companies with staying power. Here, first thing you have to look at is a balance sheet, because a lot of companies in the troubled industries are struggling to survive even in the near future over the next, let's say, 2 years. So if you look at the balance sheet, you'll know how much cash this company has, how much debt the company has to serve over the next 2 years, and that will give you good idea about the probability of this company staying afloat. And second, you have to know whether this is secular decline or cyclical decline. If you look at cyclical companies like auto industry, the company's sales go up and down every 5 years because people buy cars, and that's kind of the period that people buy cars, and it goes up and down based on this cyclical business cycle. But if you look at certain industries, their decline is secular, meaning that the sales will not come back sometime in the future. Then it doesn't matter how low the stock price is currently. You shouldn't really invest your money in these companies that are experiencing secular decline within their industry. I think this is quite obvious, but some people just invest their money in the hopes of gaining a lot of profits just based on historical stock price. I think that's a huge mistake. You have to look at the future, and you have to look at how likely the industry is going to survive in the future given the current situation. Okay, let's move on to the next rule, which says if you invest $1,000 in a stock, all you can lose is $1,000, but you can stand to gain $10,000 or even $50,000 over time if you're patient. The average person can concentrate on a few good companies while the fund manager is forced to diversify. By owning too many stocks, you lose this advantage of concentration. It takes a handful of big winners to make a lifetime of investing worthwhile. Okay, so there are a couple of points that I want to bring up here. The first one is that Peter Lynch is saying about the stocks having unlimited upside versus stocks having limited downside. So if you invest $1,000, and that's all you will lose when the company goes bankrupt. And you're not going to be liable for the level of debt the company holds at the time of bankruptcy. However, there's literally unlimited upside. So the stock can go up by 10 times, 20 times. It just has unlimited upside. But he mentioned that you have to be patient. So when the stock goes up by 10 times or 20 times, usually it takes a lot of time for the stock to go up by that magnitude. Amazon has been successful in investment for a lot of people, Google, Facebook in that regard. But if you haven't held the stock for a long time, you don't actually have enjoyed the upside. So you have to be very patient, in some cases more than 10 years, in order to enjoy this unlimited upside. Of course, you have to choose the right stock to begin with. The next point that I want to bring up here is concentration versus diversification. Peter Lynch was a fund manager, so he was forced to diversify across many different industries and across many different companies. He had a cap as to how much he can buy for any particular company, even if he really loves that company. So he was forced to diversify. Whereas you as an individual investor don't have that rule. So you don't have this limitation. You have to use that to your advantage. So if you know how to analyze companies, and if you're a part-time stock picker, then the number of stocks that you follow is going to be small. So you have to do the allocation appropriately. But Peter Lynch is saying here that owning too many stocks is not necessarily a good thing. You're going to lose this advantage of concentration. Because if you talk to a lot of financial professionals, what they're going to say to you is that diversification is always good. However, if you think about it, if you really want to get rich, then you might have to take a risk to concentrate on a few stocks by investing your significant portion of your wealth there. Because if you diversify, it's going to be a really good tool for you to maintain your current net worth. But if you want to increase your net worth over time, relatively quick manner, then concentration is a good tool. Because if you look at individual stock performance, it's a lot more volatile than the market performance. So you have to keep that in mind. There's a saying on Wall Street that if you want to get rich, concentrate. And once you get to that level of wealth, then you can diversify in order to maintain your wealth. And I agree with that approach. And also, I want to give you one example of how extreme the concentration could go. If you look at Warren Buffett's business partner, Charlie Munger, he only has 3 stocks in his portfolio: Berkshire Hathaway, Costco, and there's another stock, I think Chinese stock, in his portfolio. When asked by the audience as to whether he's comfortable, he said 100%. Charlie Munger is 100% comfortable with having only 3 stocks in his portfolio. And he asked back the audience the question that what is the probability of Costco going bankrupt? What is the probability of Berkshire Hathaway going bankrupt? Almost 0. So he's 100% comfortable putting his money in a few stocks, even though he has tons of money, right? So that's extreme case. And I think that if you truly understand a few companies, then that strategy works. But if you're not comfortable about doing the analysis and following companies, and if you think that you're not a patient investor, then it's better to diversify across different class of investment assets and across different industries, across different regions, in order for you to feel comfortable. One last point that I want to bring up here is that Peter Lynch put emphasis on the fact that a handful of big winners will make a huge change on your portfolio return. It is important for you to include a handful of big winners in your portfolio. How do you do that? So that's $1 million question. In some cases, you'll see really great companies selling at very ridiculous price. But you have to seize that opportunity once they come. And if you look around, when the valuation is very high, then you're not going to see that many opportunities for great companies to sell at low price. So you might sometimes have to hold on to cash until that opportunity comes to your way. So let's move on to the next rule, which says in every industry and every region of the country, the observant amateur can find great growth companies long before the professionals have discovered them. So this is a key point that Peter Lynch is trying to get across to readers in his book. He's basically saying that even if you might think that Wall Street analysts or Wall Street fund managers have upper hand and advantage over amateur investors, it may not be necessarily the case. You, as an amateur investor, has some deep knowledge in certain areas where you're working on. So I mentioned last time, the fact that you have more knowledge related to credit card industry if you're working in the credit card industry. If you're working for some technology company, developing some products, you have a lot more knowledge in that area than a lot of Wall Street analysts do. So if you can leverage that knowledge before Wall Street professionals have discovered them, you're going to gain a lot of profits from it. Because you're going to be at the beginning of the stage, and once this whatever new products or whatever developments turn into reality, and if everyone can see that from financial results, then you're going to make money from the market. So that's what Peter Lynch is trying to say here on this rule. Let's move on to the next one, which says, a stock market decline is as routine as January blizzard in Colorado. If you are prepared, it can't hurt you. A decline is a great opportunity to pick up the bargains left behind by investors who are fleeing the storm in panic. So, stock market has been up and down every now and then, and there have been many crashes, more than 15%. So Peter Lynch is saying that it happens. Right now, the environment we are in is a little bit weird because we have had more than 10 years of bull market, but don't think that it's going to go on like this forever. There's going to be, from now and then, crash in the market, and that's going to give you good opportunity for you to buy stocks at low prices. So if you have the cash in the face of stock market crash, and if you have courage to invest when other people are fleeing, then you can make money and generate good returns for your portfolio. And it's not going to be definitely easy. Number one, you need to have some cash in your hands. And number two, you have to have extreme courage to jump in and buy the shares when the market is crashing. Because think about if you were in the stock market in 2007 and 2008, think about your emotional state back then. Because hindsight is 22. If we go back in time and look at the historical chart, it's obvious that all the stocks were undervalued back then. But it was very scary time. If you can go back in time and if you don't know about future, then would you be able to invest your significant portion of money back then? You don't know. Like, you have to really understand your emotional strengths and status and see if you're a type of person who can do that exercise. But this is a really key aspect that a lot of value investors should learn. Let's move on to the last rule for today, which says everyone has the brain power to make money in stocks. Not everyone has the stomach. If you're susceptible to selling everything in a panic, you ought to avoid stocks and stock mutual funds altogether. This is really, really important. I think if you're value investors, you probably have heard about this one all the time. You know exactly what it is in your head. But when things really turn sour and things get really bad, you cannot help but sell your stocks in a panic. Why is that the case? I think it's because human beings are wired to act that way. Because you want to survive. If there's a panic and if there's a threat right in front of you, you run away. But the best course of action that you have to do is either invest your money if you already have cash or just stay in the market. Let me just talk about the example from Charlie Munger again here, because Charlie Munger has mentioned previously that he has held Berkshire Hathaway stocks for many decades. Throughout his holding period, there were 3 times when the Berkshire Hathaway stock had gone down by more than 50%, 3 times in his career. So what did he do? He didn't do anything. He just held onto the stock and became billionaire. It's exactly the same case for other successful people. Mark Zuckerberg, he has held on to Facebook stock for many decades. Bill Gates, Jeff Bezos, so on and so forth. And all of them have the same thing in common. They have held onto the stock regardless of market fluctuations. So ask yourself this question: would I be able to hold on to stocks in my portfolio even if they go down in value by 50%? On the flip side, you also have to ask yourself whether or not you can hold on to stock when the stocks go up in value, let's say 200%. You're going to feel the urge to sell these stocks because you want to take this profit, capital appreciation, because you feel a little bit nervous that the stock profit is going to go away and disappear. And sometimes they do. So you're kind of in a rush to sell whatever shares that you have when stock price goes down or when stock price goes up. So if you're not disciplined value investor, you're going to fall victim to this market fluctuation, and you probably have to discipline yourself further in order to avoid any mistakes in this area. If you're a trader, then it's fine, but if you're a value investor, then definitely this is something that you have to train yourself. Okay, that's it for today's show. We covered 8 different rules from Peter Lynch's book, Beating the Street. So as I mentioned last time, I'm going to have another episode for the rest of the rules. So in total, we are covering 25 rules from Peter Lynch's book, Beating the Street. You might think of these rules as very basic, and you might not really appreciate this episode. But let me just try to convince you that it is very important for you to repeat what you know. Because it's not about what you know. It's more about how you take that into action. If you're not disciplined enough in terms of these value investing principles, you're not going to react well to market crashes in the future. I personally believe that discipline is very important, and in order to have strong discipline, in order to train you for the next crash or next whatever event in the market, you really have to repeat all the things that you have learned before. It's similar to feeding yourself on the same thing over and over again until you completely master the skill set. So in that regard, what I emphasize as a value investor is that I read the same thing or same book multiple times. In some cases, if the book is really good and if the advice is valuable to be repeated. And before I end, let me just remind you that 5-star review always goes a long way on whichever platform you listen to this podcast. Thank you very much and see you next time.